Welcome to the chapter of economic decision making. In the entire subject of economics for engineers, we basically try to understand the relation between different kind of alternatives, and ultimately at the end of that particular day we need to understand and learn how to take right kind of decisions regarding the right kind of alternatives. So decision making in an organization is of utmost important. There are very different kind of decision making which happens in day to day activity of an organization. We will take examples of a few, but initially what do we mean by decision making or economic decision making? Basically, if you look at that particular slide of mine, you will see it helps us to understand the actual decision of making choices. What choice is right for the organization? Is it right economically? Is it right physically? All those kind of choice making is initially done in the decision making. Most importantly, as I have said earlier, we have to take different kind of variable parts of an organization into account before coming to a random decision. And most importantly, which is the major objective of economics for engineers, we need to understand that where lies the profit maximization for the organization. If we talk about profit maximization, we will definitely understand profit maximization to be the measurement of that particular financial benefits over the cost incurred by the organization over a certain period of time. This particularly, my students, is the base of economic decision making. The entire process of decision making can be described through a very easy flowchart. If we look at this particular flowchart, the first flow or the first work done is finding out the basic problem. Every single organization at the end of the day or throughout the day, every single day faces a different kind of problem at every point of time. So if there is a problem, there is a requirement of taking the right kind of decision. Problems basically gives us a push towards finding out the possible solutions. Now, as I say, it's solutions and not solution. Basically, every single problem has more than one solutions attached to it. Now we have to understand which kind of solution is exactly what the organization requires to solve that particular problem. Now, to compare between all those solutions, we need to find out a certain kind of ranking system, which at the end of the day is nothing but measurement of the solutions. So we need to find out a ranking system. That ranking system practically will evaluate the possibilities based on ranks. So every single solution will have a certain kind of ranking attached to it, and the best ranking, with taking into account all the single variable aspects of the organization, will be that particular effective decision that the organization needs to take for the particular problem which has been generated. So this is the flowchart of the economic decision making, or as you can see, it's the steps involved in the decision making process. Here, through this particular PPT, we will go through a number of kind of decision that the organization needs to take every single day. Now, talking about the first decision that the organization needs to take every single day is either to continue or to discontinue a particular product. If you look at this particular problem, the mathematical problem of discontinuation of a product line, you will see that what has been said in the sum, the organization is trying to find out a replacement product with the older one. Here we have the products given to us as A, B and C, the price per unit given to us as 60, 160 and 200, the variable cost per unit given to us at 40, 60 and 120, and the percentage of sales is certainly given at 30%, 20% and 50%. Whereas it has also been mentioned the fixed cost last year and the sales last year, which are respectively 7,50,000 and 25 lakhs. Now, as I have said previously, the organization is trying to replace a particular product. Now, from the actual column, you will see that product B is being dropped in favor of product D. So, the newer price, the newer variable cost and newer percentage of sales has been mentioned to us, whereas we find a slight change in the sales which rises from 25 lakh from last year to 26 lakh this year, and most importantly the fixed cost does not change. Continuing with the solution of discontinuation of a product line, basically if we have two kind of scenario, one is the existing scenario and the other is the proposed scenario or the changed scenario which the organization is willing to operate on. Now, to compare this particular two scenarios, the best way to compare two scenarios are to compare the individual profits of those scenarios. That generally gives the organization the exact kind of decision which the organization is looking at the end of the day, because all the products, all the outputs at the end of the day contributes to one single term, that is the profit, and the organization needs to maximize the profit at the end of the tenure. So let's find out how to calculate the profit for those two scenarios. As you can see, in the existing scenario, we need to find out the individual sales and the individual variable cost. Now, coming back to individual sales, total sales for the last year was given at 25 lakh. A has a sales percentage of 30, B and C has it at respectively 20 and 50%. So basically the total sales figure of A, B and C can be simultaneously divided into 7,50,000, 5 lakh and most importantly 12,50,000. Similarly, for the proposed scenario, if you can do that similar kind of thing, we get the slight change of sales to be at 26 lakh, which product A gets 13 lakh, the product D replacing B gets 2,60,000 and the rest proportion of 10,40,000 goes to product C. Coming back to the existing scenario, the individual variable cost of that particular existing scenario, we can easily find out that what we have, we don't have, should I say, if I go back to the previous slide, we don't have the contribution. So if we don't have the contribution, we have to find out the contribution. So finding out the contribution requires the individual variable cost. Now if we go through that particular individual variable cost, what we can do, sales into, should I say, variable cost per unit divided by selling price per unit should give me the individual variable cost. I am repeating it once more. Total sales divided by selling price per unit, that is for A, if you see 7,50,000 divided by 60 definitely gives us that particular figure where the number of units produced can be generated. So number of unit produced into the individual variable cost of A should give me the total variable cost of A. Similarly, that can be done for product B as well as C. So simultaneously we achieved the figures at rupees 5 lakh, at rupees 1,87,500 and 7,50,000. Now coming back to the profit calculation, we can definitely see 25 lakh from 25 lakh, if we add up all those 5 lakh, 1,85,500 and 7,50,000, we get the total variable cost figure at 14,37,000, from which we get the contribution figure at 10,62,500, from which, if we have seen in the last slide, the fixed cost is fixed at 7,50,000. So the existing scenario is giving the organization a profit of 3,12,000. Now, coming back to the proposed scenario and calculating the individual variable cost like the way I have previously mentioned for existing scenario, we get the figures of 13 lakh into 40 by 60, 2 lakh 60 into 60 by 100, 160, 10 lakh 40 into 120 divided by 200. So basically calculating all those and multiplying all those gives me, just forgive me for this particular thing, it is 15,88,167. Deducting that total variable cost with the total sales figure, which was slightly changed at 26 lakh, the next proposed scenario, we get the contribution at 10,11,833. Deducting fixed cost of 7,50,000, which does not change throughout that existing or proposed scenario, we get the figure of profit at 2,61,833. Now, if we consider these two profit scenarios, which one is better? Definitely 3,12,500 gives us the better figure than 2,61,833. What should be the decision taken by the organization? The decision taken by the organization should be the product B should be continued and it should not be replaced with product D. This is the basic decision making of discontinuation of a product line. Let's take into consideration another important decision which the organization needs to take is the expansion or contraction of that particular organization. If we go through the sum here, what we see, an organization is trying to consider expansion, which if it occurs, it will rise the fixed cost from 4,20,000 to additional 1,25,000 will be added to that figure when the expansion completes. The present capacity is at 80,000 per year, which will increase by 50%. Here comes the expansion. The variable cost, which are currently at 6.8 per unit, is expected to go down by 0.4 per unit. And most importantly, what we can see here, the selling price remains same at rupees 16 per unit. And as we know, the basic assumption of break-even point, all units will be sold. So the organization needs to find out whether it should be opting for the expansion or not. Continuing with the solution part of expansion or contraction, we can easily see now that again there are two kind of scenarios, which are existing scenario and the proposed scenario. And as it goes, the best way to compare two scenarios are to maximize the profit or to find out which particular process gives us the maximum amount of profit at the end of the day. So if we consider the existing scenario now and we take into comparison the proposed scenario, we can easily say what are the changes. The changes are fixed cost generally goes up from 4,20,000 to 5,45,000. Taking into consideration the 1,25,000 change, the capacity moves up from 80,000 to 1,20,000 with a 50% increase. The drop of variable cost per unit in the proposed one is at 0.4 deducted from existing 6.8. The selling price remains the same and the contribution. Then if we come back to the contribution per unit now, selling price minus variable cost per unit generally gives us the contribution. In existing scenario, as we can see, the contribution comes at 9.2 per unit. So basically in the existing scenario, the break-even point is practically at 4,20,000, which is our fixed cost divided by contribution per unit, or if you can see, that is 45,462 units. This is the break-even point for the existing scenario. Now coming back to the profit calculation part here, if we can take into consideration what will be sales, as I have mentioned previously, or in the first slide, or maybe in the second slide, we have already discussed that total sales can be taken into account by taking number of units sold into per unit selling price. So if we take the number of units sold to be 80,000 and per unit selling price to be 16, we get the figure of total sales at 12,80,000. Multiplying the variable cost per unit of 6.8 with that 80,000, we get the figure of the total variable cost at 5,44,000. Deducting 5,44,000 from 12,80,000, we get the contribution or the total contribution figure at 7,36,000. And deducting the fixed cost figure of 4,20,000 from that 7,36,000, we get the desired profit of the existing scenario at 3,16,000. If we do the similar kind of calculation for the proposed scenario where the sales will be 1,20,000 into 16, we get the figure at 19,20,000, the variable cost figure at 7,68,000. Simultaneously, the contribution and the profit figures are at 11,52,000 and 6,07,000. From this particular figure itself, we can take into consideration that the proposed scenario is way better than the existing scenario. But class, here lies one particular dilemma. If you look at the break-even point, the existing scenario is achieving the break-even point earlier than the proposed scenario. So as we can see, as we know that the early you reach the break-even point is better for the organization. So break-even point wise, if you just take into account the break-even point, then the existing scenario is always better for the organization. The organization should not opt for the expansion. But if you take the profit into account, the proposed scenario is better than the existing one. Now how to compare? Here comes one particular solution to this problem. What we can do, from the sum, we know that the organization is willing to expand the organization at a 50% rate, right? The production increases at 50%. Now if we can prove that the profit increases more than 50% of that particular production increase, we can definitely say that the existing scenario is not good. We should go for that particular proposed scenario. Now if we find out that particular desired rate at which the profit is increasing, we can easily find it out by deducting 3,16,000 from 6,07,000 and dividing it by that same figure, we get literally approximately a figure of more than 90%. So we can say that if the production is increasing at 50% rate, then the profit for 50% increase of production is increasing at 90%, which is far better. So the organization should go for the proposed scenario. This is how we need to find out the decision making even after calculating every single variable. Another important decision to be considered in economic decision making is whether the organization should opt for the permanently closing down of the organization, or should it wait for that particular loss region to be wiped away and the organization can furthermore achieve the profit region. So let's see how the sum goes. If we see an organization is considering closing down due to unavoidable scenario, what are the particulars or the figures that we are getting? The factory overhead, the administration overhead, the selling distribution overhead, the miscellaneous, the direct labor and the direct material. In the fixed cost, we have two particular columns. One is if the organization is entirely closed, which is closed down, and if it is kept operational. These are the two figures. Most importantly, we have the production cost. Production cost, here we can safely assume that production cost is basically fixed cost plus variable cost. So basically production cost has also two particular columns, that is 40% productivity and 60% productivity, where we find the total cost at 47,000 and 61,000. The additional informations those are given to us is the present year sales is given at 30,000 per year. The cost of closing down has an additional figure of 5,300. The cost of reopening has an additional figure of 3,400. What's the next one? Market research investigation shows that sales will be up by 12 months, or that means after 12 months the sales will be up approximately at 70% capacity. We will get the revenue of rupees 1 lakh. So after 1 year, that is, if the organization operates at 70% capacity, it can yield the revenue of 1 lakh, which was currently at 30,000. So advise what should be done. So this is the particular problem of permanently closing down. Coming back to the solution of permanently closing down or keeping the organization open for a certain period of time, let's go back to the solution. If we find out the solution, the closing down net profit figure we need to consider, and the two other levels which we are considering is at 50% and 70%. Here students, I need to mention you one thing, that I have taken 50% as 70% as to represent the midpoint and the maximum point of the production capacity. As we know from that particular sum, we have been given the production cost at 40% and 60%. But if we consider the actual middle of that production capacity, it is at 50%, and the maximum rate at which the organization is producing was given at 70% at the last line of the sum. So here I am just taking the close down to be the minimum, that is 0%, the mid level at 50%, and the maximum level at 70%, which has been mentioned. You guys are free to calculate other than the closing down at whatever percentage you are willing to take. You can easily take the middle percentage to be 35% and the highest one to be 70%. This also can be done, or you can keep the middle one to be at 40, 50, 60, whatever you wish. But this is my logic for choosing 50% and 70%. Let's go into the calculation part. If we know that from the previous sums we already have calculated the profit by sales minus variable cost gives us contribution minus fixed cost gives us profit. And here one more row has been added, that is of special cost. I'll come back and tell what are the special cost which I am talking about. Let's see. In closing down, definitely there will be zero sales. Zero sales will definitely recover to zero variable cost, whereas closing down fixed cost figure we are getting at 15,000 from the chart itself. And most importantly, the special cost which are mentioned is practically the cost which were mentioned at the cost of closing down, which was additional cost of 5,300 and cost of reopening at 3,400. Adding those two up, we get the special cost of particularly in this particular column of closing down, that is 8,700. If we add up all that particular cost of 15,000 and 8,700, the organization basically puts in a loss of 23,700. Since loss, we just cannot write minus in front of that particular figure, as we cannot say that 100 rupees is negative. So we just put a first bracket beside it to make it understandable that that is a loss figure. Moving on to the 50,000 and 70,000 calculation, or rather before moving on to the calculation of 50,000 and 50% and 70%, big pardon, we need to do a bit of working. What working? That we have found out, or from the previous figure we know that at 40% the total cost or the production cost is at 47,000 and the total cost at 60% is at 61,000. So basically del 20% production change basically gives us a change of 14,000, and most importantly then 1% change should give me a change of, or sorry, 10% change should give me a change of 7,000. So practically if we now take at 40% the production cost is at 47,000, so 47,000, then at 50% the production cost will be 47,000 plus that del 10 change, and del 10 change will be at 54,000. And then what? We already know that while the organization is keeping the factory operational, the operational fixed cost is at 23,000. Now if we deduct it from the total cost of 53,000, we get the variable cost at 50% to be 31,000. Is it clear? If this is clear, let's go back to the 50% calculation. Here we have been mentioned that sales that year would be considered at 30,000. We have taken sales to be 30,000, variable cost 31,000, I have already shown it in the calculation, and fixed cost to be 23,000. Adding those two cost column, we are getting the figure of 54,000, and deducting it from the income we get a loss of 24,000. Clear class? Moving on to the 70% column, we know from the last line of the sum that the sales at that particular point will go up after 1 year at 1 lakh. The variable cost figure very similarly to that one, 61,000 plus 7,000 should give me the total cost at, or production cost at 70% at 68,000. Deducting fixed cost from that 68,000, we get a figure of 45,000 variable cost. So 45,000 variable cost and fixed cost of 23,000, adding those two costs we get a figure of 68,000, and 68,000 deducting it from the sales figure we get a profit of 32,000. So practically now come back to the decision making part. If we consider the decision making part in plain sight, the organization should close down as the lesser loss is there in the closing down, which is at 300 rupee less. But here the organization needs to reconsider its decision, as the loss of 300 rupee is very much negligible for an organization, and if the organization bears that loss for one particular year of negligible 300 rupees, it can earn 32,000 more after 1 year. In my opinion, if you ask me students, the organization should bear that particular loss of 300 to earn the profit of 32,000. Here my decision making will be the organization should keep the organization operating and should wait for the profit increase.